Welcome to Personal Wealth Strategies monthly webinar series. Thanks again for joining us today, whether you're watching here live or watching in the replay. This is the 25th or 26th straight webinar that we've done monthly for about 2+ years now. And I think this one, looking at the presentation, looking at the topic, is going to be the best one yet. And today we have a very special guest, advanced tax strategist. We are going to, I'll introduce him a little bit more later, but Ryan, if you'd like to share your screen, just to show the intro slide. But today we're talking about advanced tax planning for both business owners and high wage earners. And we're going to get into a little bit about what that means, but it is definitely going to be a highly relevant and a highly potentially dense topic. But with everybody having their taxes due right around the corner, I thought this was an appropriate time to talk about, hey, what can we do this year? And footnote, there is a potential to look towards last year, even 2023, if you've got some extensions and things in place, which Ryan will talk about when we get to that relevant section. But first, before we get into that, what is tax planning? And what it is not tax preparation. So that's what is done by your accountant, your tax preparer, your CPA, your enrolled agent, or you do it online yourself, TurboTax, or you go to the local H&R Block. So that's really just focusing on keeping you compliant, making sure that all of the correct numbers are filed and that you're paying, exactly what it is that you should owe, not more, not less. That's not what we're talking about when we're talking about tax planning. What tax planning refers to is the comprehensive review of your tax return, typically prior year, and your current situation, to then help to identify opportunities that you can take both now and looking into the future that will keep your lifetime tax liability as low as possible. And this webinar in particular, we're going to be talking about advanced tax planning strategies. And so we're not going to be talking about some of the more I'll call them basic, but for you, they may be intermediate, like charitable gifting strategies such as donor advised funds, qualified charitable distributions. We're not going to be talking about normal IRA contributions to help save on money. We're not going to be talking about the Augusta rule, which is another thing, or forming S corps to do that. I mean, your accountant can definitely discuss all of that. We're going to actually take it even a step above that to discuss some advanced tax planning strategies, which is why I brought in this man, Ryan Foncannon. So if you go to the next screen, just wanted to read a couple of the accolades that Ryan has. As you can see, he's been on the cover of magazine by voted top tax and wealth strategist of the year 2024. He was awarded the top advanced tax strategist at the Money 2.0 conference. He is the global award winner as a thought leader and game changer in the tax and financial space. 2023 most dedicated retirement planner in Indiana Wealth and Finance International. He co-hosts a weekly platform for case studies for both financial professionals and tax professionals, and has a mastermind for tax professionals. So he's actually teaching CPAs, EAs this stuff so they can take it to their clients. And he's got 30+ tax offices that he works with and growing. He's also the author of upcoming books, which will hopefully be out this year in 2024, just about this subject as well. So without any further ado, I want to introduce Ryan Foncannon.
Yep. Thank you, Justin. And just to kind of give some quick notes about Justin. Justin's not just like a regular financial advisor. He's very holistic, very proactive, and we've done some work together and everything. And he's a very trustworthy person. We've been friends for quite a few years now. And there's probably not a better person that I would trust in the financial space. Absolutely. And I know he does a really great job with his clients and goes very, very deep, not just doing traditional stuff. He knows his stuff very, very well. So I think there's probably, yep. I'm sure there's some people on here that already know that, but it's always nice to give some love back. So a little bit about us, we've got a virtual family office. So we do quite a lot of different things. Our biggest thing is that we solve big problems, whether it's for business owners and or high wage W-2 earners. I think the differentiator for us is that the advanced tax planning, and it could be capital gains that we can help with. It could be a combination of like a business owner is like, okay, I bought a bunch of trucks. I still need some more deductions. What else can I do? And we're going to kind of go through some high impact strategies that we're going to talk about here today. And then we also help a lot of high wage W-2 earners that, they're W-2, they don't own a business. So it's really hard for them to find other deductions that they can actually take. And I think a lot of people that we talk to, they hear about, like, Jeff Bezos or Donald Trump or somebody, that's paying very little or no taxes. And like, oh, I know there's ways to do it. I just don't know what's available out there. So that we've spent like the last probably 13, 14 years just doing a lot of research and making, learning tons of things, webinars and books and a lot of conferences. So we've went out there and really tried to find these strategies that are on Wall Street and kind of bring it to Main Street. So that's a big part of what we do. So why should you consider advanced tax planning? I think everybody's been infected by inflation. Costs are going up everywhere across the board, whether it's business costs, whether it's personal costs, whatever it is. Being able to do advanced tax planning is going to help you net out more money during the year. And there's some strategies that actually have a cash flow component to it as well. So it can also help you build wealth. And over time, it's a great way to, offset those taxes. I think tax is definitely, it's important. Absolutely. But it's also, I think people don't look at it as it being pretty much your biggest expense outside of maybe children. But definitely us showing you different ways to mitigate the taxes, defer the taxes, or even eliminate the taxes. And I think a big thing that we like to do is show people different ways that they can give to charity, allowing people to have more options. Maybe saving some money on taxes is going to allow you to hire more employees as a business, maybe get more equipment, maybe even just enhance the experience for the employees. Maybe you're able to bring on more benefits because you're saving on taxes and everything. So our niche, we are not trying to replace anybody's tax professional. We like to enhance what's already been done. So that's why we work with so many different tax professionals nationally, is that they bring us in because they've gotten to a certain point where they can't find any more deductions or out of ideas. And some of the strategies we use require another professional to be brought to the table. So we do a really great job of educating the tax professional about what's available, and then also educating yourselves, like the client, and what's available. And we're kind of like the tax Sherpa. So we'll go through each option. We'll talk about the pros and cons. We'll show you, hey, if we max this out, some things have like a 30% of your AGI or total household income limit to it, but we can also add another strategy right next to it. So I kind of call it playing in the IRS sandbox. As long as you play within the sandbox, according to the IRS rules, you're okay. And I think there's some strategies out there that got pulled further than they were meant to go. And that's where like a lot of them get in trouble and everything. And I think the reason is they only use one strategy instead of bringing on different strategies to lay next to each other. So they kind of come together. That's where you get the really high impact. But we do a really great job of showing the different options. Hey, let's do a combination of these, showing these. And sometimes I have clients like, all the options that we show. And other times we're like, well, Ryan, I don't really like that one. I don't really like that, but I love that one. Let's do that one. And I'll also talk to them also about what the minimums are, because some of them have a minimum and maybe they're not open to maxing it out, but they're definitely willing to dip their toe in the water. So that's a lot of the stuff that we definitely bring to the table on that. So let's talk about some high impact business owner strategies. So if you're a business owner and you're looking for some more higher impact type of tax strategies, there's one, the 831B, that's also known as a captive insurance company. So it's like as a business owner, you're creating like your own insurance company, and you're able to get some more deductions that way, but you're also able to protect yourself more. And then an alternative to that, we also call it alternative risk transfer. It's also called private insurance. So it has a lot of the components that a captive has. And there's some other stuff that the captive can't do. So a captive does have a limit on it. So like, I think the limit is about 2.5 million here for 2024 that you can actually put into it, while the private insurance does not have a limit on it. The captive allows you to, it's almost like another retirement account. So whenever the business owner decides to retire and or sell the business, there'll be that money within the captive that they can actually use and put that towards retirement and everything. So not only do you get the good deductions, there'll be kind of like what I would call another bucket of money that would be available. While the private insurance doesn't necessarily have that, they can be a little friendlier on the cash flow, where we could use financing, using an interest-only loan, and the business owner only has to put in about 12 to 15% of the premium but still have the same effect on the deduction. So the deduction would be the same. They'll get the $100,000 deduction, use a return of premium rider. After 5 years, the premium comes back if there's no claims. And a lot of these claims, the risk that they're both insuring is very low risk, very limited in terms of the frequency. So it as an example, like a trucking company. We had a trucking company. Their insurance premiums kept going up quite significantly over the years. We were able to use the captive to have a deductible reimbursement. So we were able to bump up the deductibles on the insurance they already had. We didn't try to replace it. We just bumped up the deductibles pretty significantly, which lowered the insurance costs. And then we had a deductible reimbursement within the 831B. And we could also do that with the private insurance as well, that increased the cash flow, gave them some more protections they didn't have. And, also got the great deductions as well. So they were able to lower the taxes overall. So these are really great to use. The captives were under some scrutiny from the IRS a few years ago. Now they're mostly focused on the ones that are domiciled in Puerto Rico, because the IRS feels that there's not enough of an arm's length transaction happening there. And there's some unique things about Puerto Rico. The federal taxes are much lower there. And then also what they call the segregated account. I won't get real too in the weeds. I don't want to lose everybody, but just knowing that we stay away from the Puerto Rico captives, but those are the ones that the IRS are looking into. So I think some people had heard about the old challenges from the IRS and the tax court with the captives. So all the captives domiciled in the United States are okay. So it was domiciled. A lot of them were domiciled in North Carolina. They've got some special provisions and state law there that definitely makes it more attractive to do it there. So there's definitely tons of different options out there to create those high impact strategies. And I think I like something else with the tax strategies, that some of these strategies like the captive or the private insurance, it's almost like a Swiss Army knife, because you get the tax benefit, but then there's also a benefit either improving the cash flow, lowering insurance costs overall, and then also kind of creating that extra bucket of money to use towards retirement. So it's kind of checking a lot of boxes by just using one strategy instead of using several different strategies that maybe do not quite get the same benefit, the net benefit to the client and everything. So within the captives, a big thing is to build accessible reserves, protecting the cash flow from intangible risk, natural disasters. I know during COVID, the supply chain interruption, I know there's tons of companies out there that the supply chains just got messed up, with the ports and the boats being off in the ocean for months on end. And if you can't get the parts, you can't, build the trucks, you can't build the buildings, you can't, build the products and everything. And there's even some unique pandemic coverages that you can get within a captive or private insurance that you can't get through regular commercial insurance. Another thing that I think a lot of people, a lot of athletes will use the private insurance or a captive to even protect their brand and reputation. So there's some unique things that you can use the captive for to get more protections, but then B, also, like I was saying, like the extra bucket of money. And then we've used it to even help with lowering group insurance costs, workers' comp, malpractice insurance. We've used it for that as well. And even a great thing I'll talk a little bit more here is about increasing revenue. We worked with even some dental practices out there that they kind of we created like their own special dental plan within. So they use the captive to create the revenue for that particular plan. So it comes out a lot more tax advantaged versus if it's just a regular revenue that way. And plus, you're also building the reserves of that bucket of money over time as well. And we even used it for warranty products. We've worked with some car dealerships that we're able to create special types of warranty programs, either for their used cars or even new cars and everything. So it's another way to generate more revenue in a more tax advantaged way. So like I said, the dentists, orthodontists, physicians, attorneys, accountants, we've even been working with some tax professionals to bring this to their office to create this extra stream. So it's like, hey, I want to also back up my work. And then that creates that revenue stream there. Plus it's more tax advantage and we're getting that extra tax deduction up front. So beyond the 401k, so I know I'm sure everyone's familiar with the 401k and everything, but there's other qualified plans that maybe don't get talked about. And Justin would definitely be a great person to talk to about these things. A profit sharing plan. We've worked with somebody that actually was a W-2. And they also started a consulting business on the side, and the consulting business kind of started to take off. And he's like, man, I need to find some more deductions. So using a profit sharing plan with that business that's outside the W-2 job could be a way to get another deduction. Using cash balance pension plans could definitely allow business owners to put away six figures. It could be multiple six figures that way. A 401h is kind of like an HSA that you use in retirement. So you wouldn't use it today, but you could use it in retirement. So there's quite a few different extra things. The thing I like about the, beyond the 401k is that if you've not filed your business return yet and you're on extension, you can talk to Justin about, doing a cash balance pension plan, a profit sharing plan, regular IRA or a SEP plan. Those are still on the table. So there's a great way for you to get some more deductions that way. And Justin could definitely go more into detail on that. But they're definitely certainly things that are, I think, even sometimes the tax pros forget about. Oh yeah, I could throw some money even at a SEP right now as a business owner and everything that I'd rather keep money for myself than give it to the government.
Yep.
And plus,
and Ryan,
the
401h really quickly
yeah,
blows my mind as well in terms of the advantages of that, but people don't know about it. And people, love the HSA for good reason, because of the triple tax-free nature. You get a tax deduction on the way in, gross tax deferred, and you get it out tax-free for qualifying medical expenses. The 401h works exactly the same way, except typically, because it's based on income and things, you can fund much more than you could into an HSA, into the 401h. And that account is triple tax-free, which is a lot of these things we're talking about just deferring the tax when we're talking about 401ks, SEP IRAs. But for 401h, assuming that it's later spent on medical expenses, which we know in retirement is going to be a plethora of medical expenses that occur in retirement. We can use it specifically for that and get it out tax-free. So that money that goes in there is essentially never taxed. Not even on the way in, you get a tax saving. So it's one of the most, if not the most, tax favored accounts out there, and is rarely talked about. So I'm glad you had it on the slide here.
Yeah, absolutely. And there's some great things within the 401h. We've had clients that used it even towards long-term care. So they funded a long-term care policy, maybe even a hybrid policy that had the life and the long-term care in it through the 401h. So they got the full tax deduction versus if they just went the other route of the long-term care has a little bit of a cap on it. I think it's like a little over $5,000 a year. But within the 401h, you get the full tax deduction for all the dollars that you put into it. And 401h is also great for a lot of high wage earners that are going to be making quite a bit of money in retirement. So there's the IRMA surcharges that happen. So if you're making X amount of dollars, the government's going to take more money out of your Part B premium, out of your Social Security check. It's also going to make your drug plans a little bit more expensive. Well, the 401h will reimburse you for that. They'll even be able to reimburse yourself for those Part B premiums. So if you're having to pay those higher Part B premiums, you can reimburse yourself fully through the 401h. So yeah, the 401h is very, very flexible plan. And, Justin would be happy to talk a little bit more about that and how to maybe implement that on top of the cash balance plan, on top of the profit sharing plan. So you could really see how some business owners could really take advantage of this. And that's where we're talking about being able to put away an extra, 2, 3, 4, maybe even 500,000 or 600,000 a year, using, leveraging these different types of plans. So yeah, non-labor costs to offset inflation. So this isn't necessarily a great tax strategy, but it's definitely from a cash flow standpoint. There's definitely some specialists out there that help with what we call cost remediation, which in English just means that it's all non-labor costs. So like one of our specialists that we work with says there's cash and trash. So the different things that maybe you're throwing away might be worth something to somebody else. And I'm not saying that you have to become a trash panda and start digging through the trash. There's some different things in the trash that could be profitable by separating it. We actually worked with a local surgeons group here, and just on the medical supplies, we were able to lower their cost by $400,000. So that within that 400,000, like, well, Ryan, now you just created more of a taxable issue for myself. And I was like, well, we can redeploy that into the qualified plans that we talked about, or we actually added some more things in terms of we were able to offer a profit sharing on top of the 401k that they're offering their clients. So it kind of opens up more options, and then we can deploy that in a way that's very tax advantage into some different things like the captive, like the qualified plans that we talked about, or some other stuff. So it definitely allowed them to even, I think they even hired somebody. They were on the surface with their budget, they weren't able to hire them, but after we were able to create that 400k, it's like, oh, we can afford to hire this person, add some more benefits on for our current employees. I know everybody out there that does have employees, it's hard to keep people these days. There's a lot of job hopping, and it's also hard to find new people that are even going to show up to the interview, let alone stay with you for a while. So there's definitely a lot of great things that you can do within the planning that we can bring to the table. Labor costs, offsetting inflation, so improving profits, making sure all the available tax credits that are being available via the government. So the government has a lot of incentive programs for businesses that a lot of people do not realize that are available. We even worked with a manufacturing group here locally. There's something called a WOTC, so it's WOTC. It's also called a work opportunity tax credit. So they actually happen to hire a lot of people that maybe were on state aid, veterans count, felons count. So they were hiring a lot of these types of people, and they didn't know they were leaving six figures on the table just in tax credits. So we were able to put them into a payroll system. They had one payroll system, but there's a few other payroll systems out there that will naturally screen these people in the application process to say, oh, okay, this person would qualify for that particular tax credit. And the thing with that too is to have the automations. There's about 5 government agencies involved with this WOTC. So nobody wants to be filling out that paperwork. The tax professionals don't want to do it. I don't want to do it. The HR person doesn't want to do it. And it all has to be filed within 28 days for it to count. But then it's like, oh, I'm leaving 6 figures on the table with tax credits. That's a huge thing. And there's also some other tax credits with an empowerment zone. And that's it's drawn out by the government. So certain places that may be in a nice area, but they're just trying to empower that area to bring more business, more jobs to that area. So a lot of places I didn't even realize I was in an empowerment zone. So they qualify for that tax credit on top of the work opportunity tax credits. So it's definitely something that we like to take a look at. Not everybody qualifies for that, but it's also something that I think there's a lot of people that are leaving thousands, tens of thousands, maybe in 6 figures on the table in terms of tax credits in those areas. So it's definitely something to at least be top of mind, or that's something that we think about. So that's why people talk to us. So let's talk about some strategies for high-wage W-2 earners. Now, the neat thing about this is the strategies we're going to talk about go on the joint return or single return, also known as the 1040. So if you are a business owner, you can actually also take advantage of these great strategies. We like to really say the high-wage W-2 earners because they're the ones that are making great money, but ran out of ideas, or there's no ideas they know about that they can actually lower their taxes significantly. So the first one is LCD. It's a leveraged charitable deduction. So this is the one that has, via the IRS code, the max is 30% of your AGI, which in English is just basically your total household income. So it's like your income, your spouse's income, investment income, rental income, everything in the pot all together. So that's basically what the AGI is in English. And how this works is that there's a mineral that's been used the last 5 years. About the first couple of years that we use this, it was magnesium. The last 2 years, it's been lava rock. It'll be lava rock again this year. And what they do is a partnership is set up. The partnership gets a huge bulk discount for buying this asset all at one time. So this past time with the lava rock, they purchased over $190 million of lava rock. So that's a lot of lava rock to have laying around. So since they bought that much of it at once, they were able to lower what it costs. So they were able to get it down to 25 cents on the dollar of what it would normally be worth. So that partnership holds that asset for 12 months. So if it was bought in September of 2002, it had to be held till September of 2023 for it to get the step up to fair market value. So now it's worth the full dollar instead of 25 cents on the dollar. And why is that important? Well, there's also what they call tacking on rules via the tax code. So anybody that purchases interest into that partnership gets that step up as well. So it doesn't matter if they're in it for 7 days or 7 months. they get that step up to fair market value, but they can come in at the amount that it was originally purchased by the partnership. So using an example, somebody put $25,000 in. At the end of the year, when the asset is actually donated to a charity that already has a LOA or letter of acceptance, they know that all this lava rock's coming their way. They don't go knock on someone's door and have a dump truck full of lava rock and go, okay, we want our deduction. So they already know it's coming, and they actually have a way to capitalize on that, which I'll talk to here in a minute. But once it's donated, that $25,000 turns into a $100,000 itemized charitable deduction, which is really, really great. And this is a very, very unique strategy that's been around for a little while. I think the hard part is all the leveraging happens in the beginning. So you're getting it at 25 cents on the dollar. Partnership holds it for a year. Now people can start purchasing interest into that partnership and get that 4X on it. So once it's donated to the charity, they know it's coming. The other part of this deal is that they've already found capitalization partners to purchase that lava rock from the nonprofit. So the nonprofit's not really equipped to handle, what are we going to do with lava rock? So they've got partners in the back end that's going to purchase it from them. So that way they get cash for the lava rock. So it's a win-win-win across the board. And the thing that I like about this also is that it has a market price. So we can't influence the market price. It's worth what it's worth on the day that it's donated. I don't know if some people have heard of conservation easements or CEs out there. The big issue with that was I think people kind of stretched, like I was talking about before, people stretching a strategy further than it was meant to go. They stretched that strategy further than it was meant to go, and it became under huge scrutiny from the IRS. And the issue with that one is the best use of the land. So I could have gotten 10 different appraisals. I would have had 10 different answers with a conservation easement. And some got into the double digit range of like, okay, it's a 16X, it's a 15X, it's 12X, it's a 9X. And it's very, very, very subjective in terms of what those appraisals came back. And that's what the IRS didn't like. And the thing that makes this very unique is that I get 10 different appraisers. They're all going to say it's worth the same amount with this specific strategy. So that what makes this a lot different from the CE. And I think I've come across the people out there that confuses this strategy with the CE. I go, well, this one, all the leveraging happens in the front, and then it has the step up the fair market value, and then it's worth what it's worth on the day it's donated. So there's no wiggle room on the back end for this to have any more than the 4X that's allowed via the tax code and everything. So the client gets a K1 form 8283 in English. That's a tax form. That's for donating an actual physical asset to a charity. And then you get the appraisal that backs up all the numbers that says, okay, yes, it was worth this when it was purchased. It was worth this when it was actually physically donated to the charity and everything. And the minimum on this particular strategy is 25K. To use an example, so let's just say your AGI or total household income is $1 million. So the max we can do is 30% of that for the itemized charitable deduction. So that would be 300,000. Now to max that out to the 300K, divide that by 4. So the max contribution a client can make to max that out is 75K. So you put 75K in, you get a $300,000 itemized charitable deduction. So it's very, very, very unique. And I've had a lot of clients, and this is the ones that I kind of, talk about being a tax Sherpa, so to speak, that they're like, well, Ryan, I don't really want to max it out. I just want to do the minimum 25K. So I always let my clients know that the 25K is the minimum on that. So this is a great strategy that we use, that we've had a lot of clients, especially high wage W-2 earners, take advantage of this, but we've had a lot of business owners take advantage of this as well. So it's a really, really great strategy that's very limited since there's only so much inventory of it. There's not everybody is like, well, Ryan, how come I've never heard of this? I go, well, there's not billions and billions of dollars of lava rock laying around. Plus, that'd be very, very expensive to purchase that. This was already purchased by a billionaire that had $191 million kind of laying around to be able to set this kind of type of strategy up and everything. So this one's very, very unique. Not saying this is the only charitable strategy that's out there, like Justin said earlier, donor advised fund, but it is something that's very, very easy and quick. So we're able to use it in the fourth quarter. We do a lot of tax planning throughout the year, and a lot of the strategies that I talk about today have to be put in place, funded this year for it to count for this year. So there's not a lot of strategies out there that you can go backwards. So back to 2023, the qualified plans we talked about before, the cash balance, the profit sharing, the 401h can still be put in place, via Justin, for last year, if you own a business and everything, and he'd be happy to have a conversation with you about that. If your tax return has not been filed, if it's on extension, then you can still put that in place before September. So here's another strategy. I call it the boomerang strategy, also known as a hybrid tax and investment strategy. So it's got two components. It's got the upfront tax incentive of being able to put money into it, and then the goal is to get your money back plus interest within 3 to 4 years. This is a gas and oil drilling contract, and it's only dealing with U.S. Barrels of oil. So it's not, they're not drilling for oil in Africa or Australia or some other place and all that. It's all actually happens to be in the Permian Basin in Texas. So we work with the largest group that's been doing this. They're the oldest. They're family owned. They don't do any wildcatting. Wildcatting in English is they're hoping to find oil where they're going to be drilling. This company does tons of research. They know that where they drill, there's going to be oil. They also do quite a few wells. I think this year for 2024, they're going to probably drill around 64. Last year's fund is drilling 62. And then the fund before that drilled 60. So there's a very large amount of wells that are being drilled. Some of the other groups that I've talked to out there, they only drill like 6 or 8 or maybe even 12 wells in their fund. So the less wells you have, the higher the risk is that maybe a few of those wells do not actually hit oil. Now, there's usually clusters of 6 of them that are drilled at one time. So that's what I love about this group, of the research that they do. So a little bit more about this strategy. So the way that we were able to do, you put 25K in, you get a flow through loss on a K1 that creates basically a $25,000 deduction on your 1040. And then the following year, so if some people got into it in 2023, it'll start paying out quarterly distributions as the wells come online. And the goal, like I said, with the investment strategy on the cash flow is that to get your original investment back plus interest within 3 to 4 years. And in the first year, as they can't deploy all the wells at once, there's something called spacing via the tax code. So each quarter, there'll be more and more wells coming online. So that just means like the cash distributions are going to go up. And the other thing I like about the cash distributions, I won't say they'll be tax free, but they'll be very, very tax advantaged. So they'll have a combination of depreciation, and they'll also have what they call depletion allowances, very unique to gas and oil, that other strategies or other investments don't have that. And the other thing that I liked about this strategy via the tax code 469, which is probably my favorite part of the tax code. Not to nerd out on you guys and everything, but that strategy, or section 469, takes a passive activity, and this would be considered a passive activity, and makes it active. So it gets an exemption of being active. So you're actually allowed to use it to offset earned income. Otherwise, it would be considered a passive activity. And other things that would be considered a passive activity would be like rental income and things like that. So you can't take the losses necessarily to offset your earned income as a W-2 earner and everything. So that makes this strategy very, very unique. And definitely somebody greased the wheels with DC with Congress to get that put in there. But it's an incentive program that I think a lot of people just do not know about, that you can A, get the tax deduction, and then B, you're gonna get your original investment back plus interest over time. So it's definitely a great thing to use. It's very flexible too. It can offset wages, it can offset profits, bonuses, capital gains, rental income, royalties, all the things. So it's very, very unique strategy that we like to use. And we also like to use this strategy either by itself or in combination of like what we talked about, the LCD or some other strategies on the 1040 that we like to bring to the table and everything.
And Ryan, just to confirm, this
Yeah.
strategy is an above the line deduction, and I'll translate that when you answer yes.
Yes.
Okay. So what that means for us, a normal folk out here, above the
Yeah.
line means that it actually reduces your adjusted gross income. And so for things that are based on your adjusted gross income, such as student loan payments, such as QBI, qualified business income deductions, such as, credits for, solar credits, electric car credits or whatever, that you can only get up to a certain AGI. This strategy could allow you to reduce your AGI enough to then qualify for additional credit. So it actually could have a compounding effect on your tax savings. So it's not just the savings that you get from this, but also potentially some other savings that you can get by reducing that adjusted gross income level.
Absolutely. Yep. It's definitely, yeah. It's very, very flexible and can do a lot of different things, like Justin said. And it's great to, yeah, like you said, even lowering maybe your potential student loan payment. So yeah, we've even used it with the IRMA surcharges that we were talking about for folks in retirement making lots of money too. That it's very, very flexible and above the line. It can also be used with the standard deduction too, since it's above the line. So it's a very, very unique strategy. So this one is called the Structured Ownership Program. I won't get really into the weeds on this one. I always like to tell my clients, this is a very sophisticated strategy, but it's a great strategy that we've used for a lot of clients. So we can't offset wages or your W-2 income with this, but if you're a business owner and or you have a large capital gains event, we can offset the taxes that way. So this one, on the capital gain side, it has a 10x component to it. And then on the K1 income, so the K1 income be profits from your business. It could be rental income. It could be your royalties, a farm income, all the things that might happen on a Schedule 1 income. So anything that's not wages, basically, that comes in. So this one definitely has some unique components to it. In terms of, okay, there's a capital contribution, and then within that, there's an interest-only loan that's taken out. And there is an entity here. It's a new series LLC. So the client retains 99% ownership of that. And then they have the master LLC, the 1% owner. So we have someone that used to work the desk, or actually ran the desk for Merrill Lynch a long time ago, that deals with for foreign exchange trading. They do factoring, they do high volume trading. And what they do is they're able to create much higher fees than you could create if you just went to, like something like Justin or something like that. They're not going to be able to create these very large fees to offset the K1 income, or the K1 loss is going to flow through. So it's very, very unique. It also involves Section 469. Within 469, allows this passive activity to offset the earned income. It just can't offset the wages on your tax return. But this is a great one that we actually used in combination with some a car dealership. There was two brothers that happened to sell one of their dealerships. Plus, they were also making very high profits, 7 figures. I think one brother was making $1.5 million. The other brother was making about $3.5 million just on their profits from their company, not including the wages. So we left the wages alone, but we were able to offset 100% of the capital gains and about 90% of the other income using this strategy. And we actually use this strategy in combination with the LCD. We like to diversify the strategies. We talk about investing, diversifying. We also like to diversify the different strategies that we use on a tax return. So we're not solely just wanting to rely just on one strategy too. So that's also a great way to, all the stuff that we use has also audit protection within it. So we're also, very cognizant of making sure that people still pay some in taxes. I know out there in Jersey, the state always has their hand out, and the taxes are very high. So we're very cognizant of making sure that they do get something, and if they get something, they're more likely to leave you alone. But everything we do work with does have audit protection built into it, and it's also, I think this particular strategy has been challenged 4 times by the IRS, and there was no change each time, and it's been around since 1999. So yeah, definitely this one is definitely more sophisticated for sure, but it can have some really high impact for the right clients and everything. So green strategy. So I got some clients that love gas and oil, and then I've if some other clients that hate gas and oil because of the carbon emissions and everything. And that's okay. We're very agnostic. We like to listen to our clients. If they're like, Ryan, I'm very green. I love the environment. It's like, okay, definitely not bringing gas and oil to the table. But they're like, well, what else do you have? So we have a green strategy. I won't go super in depth into it, but it's what we call a solar business purchase. So this isn't a security or anything. You're actually going to own a solar project on another building. usually like a hospital, a church. There's actually a lot of ice rinks out in New Jersey that have used this. So you're going to own like that solar project on top of like a hospital. So the hospital, owns the building, they own the land and everything. You are actually going to own that project on top of the hospital, or in some cases, even a school. We've even done quite a few boys and girls clubs, so that the property owner is going to pay for access to that electricity, but they're not having to put down any money. So what they do is they're able to show the group, the property owner, at least 40% savings in electricity day one once it gets turned on. So that's very advantageous for budgets. So that's why a lot of nonprofits like this is like, oh, okay, we know that we're going to start saving 40% electricity, and it's going to be locked in. We know what it's going to cost, and then they'll have what they call an escalator in there. The escalator is already built into the contract. It may be 3 to 5% each year, but it's very easy. Now you're taking a variable cost, and now it's a fixed cost. So that's why a lot of nonprofits and different groups love this strategy. A, they're not having to put any money down for it. And then B, they know what their electricity is going to cost. And the great thing is for the taxpayer, they own this project. So it has what they call ITCs, or investment tax credits. And the great thing about the investment tax credits, it got locked in at 30% for the next 10 years to 2033. 2033, at least 30% of the solar project will be an investment tax credit. And the great thing about the tax credit that makes it very, very unique is that you can carry it back up to 3 years. Now, the IRS has a limit on that, so you can only offset 75% of your federal tax liability, or in English, basically the money federally that you have to pay to Uncle Sam. So we can only offset up to 75%, but we've used this strategy even for some large capital gains events that someone had that, maybe their tax professional or somebody just said, hey, just pay the tax. They're like, well, that was 6 figures, that was 7 figures. So we're able to offset a good chunk of that using the investment tax credit, being able to carry it back up to 3 years. Or you can use it currently. So you can use this as a W-2 high wage earner on your 1040 and or as a business owner. The other great thing is that you're going to have federal depreciation deduction on your tax return for this year. And then, folks like that live in Jersey or other states that have high tax, you can also get a state depreciation deduction on your tax return. So now you're getting tax credits, you're getting a federal deduction, and then you're also getting a state deduction. So that's really great. And then the cherry on top is the fact that you're going to get a cash flow. Now, I won't say this strategy will cash flow as well as like maybe rental property, but it'll pay out net about anywhere from 3 to 8%. So not bad. But the idea is that we're going to reposition the money you're paying Uncle Sam into this strategy or some other strategy. So that's where like the proactive holistic planning comes into place. It's like, okay, let's take a look at this and at least see if it's an option. Now, some things about this strategy is that the minimum size is 200,000. So it does kind of eliminate some people that aren't able to afford that, but for the ones that are, the 200K may not also be one project. It might be 2 or 3 projects to get to that 200K for it to make sense with the numbers and everything. And the thing that makes this not a passive activity is the 100 hours of material participation. So you're actually, you're going to get your own portal. There'll be tons of paperwork in there that's on a monthly basis. There'll be a P&L statement that you'll be able to get. Also videos about education. You'll also get everything from the construction and everything that you can split that 100 hours 50-50 with a spouse. So the spouse can also participate. And there's also some other ways is you do a site visit to get the 100 hours as a couple. So you can actually fly out there, document how long it took to get there, the time that you spent there at the site, whatever, to get the 100 hours. So there's a lot of different ways to get to the 100 hours. You can even go, there's a big solar conference every year. By actually traveling to and from and spending time at that conference, you can get the 100 hours that way. So yeah, we've had quite a few couples take advantage of this, and the 100 hours in material participation allows you to offset earned income. So that's a great thing about this strategy. And I think even the greater thing is that you're helping the environment as well. So it's a kind of a win-win for the taxpayer. It's a win for the nonprofit or the property owner being able to take advantage of this strategy. And they really like it since they don't have to put any money down, like I said. And then they're also able to take a variable cost and make it a fixed cost. So this is a very unique strategy. There's only so many projects out there. So this one definitely has like an inventory to it. As we get into the fourth quarter, I usually take this strategy off the table because there's not enough time to get the 100 hours of participation without doing a site visit. So it's usually I talk to a lot of doctors and stuff in the fourth quarter, and their schedule doesn't allow for them to go take a trip out to California or wherever to go do a site visit. So there's just not enough time to actually for it to pass a sniff test with the IRS. But the great thing about the portal too is that it will log when you logged into the portal, the date. So if there's ever an audit, all that information is available for the IRS to take a look at and say, be able to document that, okay, I did spend that X amount of time doing these things and reading over the paperwork and all of those things. So yeah, it's definitely a great strategy. I don't think a lot of people know about. They know about putting solar on their house, or they know about getting like an electric vehicle, but they don't necessarily know that, hey, I could actually kind of have like my own solar business. And there'll be some opportunities with that too, with some different deductions, home office deductions, things like that, since you actually technically do have like a solar business that way. So the problem today, so I get this quite a bit. So why haven't I heard of any of this stuff? And this isn't even all the strategies that are available. They're just like some of the higher level ones that we like to talk about. And they're pretty easy to put into place too, is that a lot of tax professionals out there just have so much going on. A lot of times, some of them are even acting as counselors for their clients on top of being the tax professional. But they're dealing with, the tax law. The law is always changing all the time. So they're just trying to keep on top of that, on top of doing the books, on top of helping nonprofits, on top of helping businesses. And, this busy time of year, they don't have time to learn about new strategies. So that's where we come into play, is that we help educate them about these strategies, because a lot of times they've either kind of heard about it, but they don't really know a lot about it, or they just never heard of the strategy. So we do a really great job of not only talking about the strategies with the tax professionals, but we also talk about, okay, here's why this works. And we go through the tax codes that are involved. So a lot of these strategies have more than one tax code that's involved with it. But being able to really kind of get down in the weeds with the tax professionals and showing them why it works, and the limitations of what the IRS, the parameters they put in place to make sure that we're staying, crossing all the T's and dotting all the I's and all of that. And also, everything that we talk about, like I said before, has audit protection with it. Yeah. So I won't go real deep on this one, but yeah, we actually had a doctor here in Indiana. I live here, southwestern Indiana, that 1.8 million in AGI. She was getting distributions on profits for their S corp, but also had 540K in wages. And on that particular case, we actually used the boomerang strategy, the gas and oil plus the LCD. We weren't able to eliminate all her taxes. We eliminated, a couple $100,000 in taxes for her. And she's looking at actually doing the solar opportunity this year as well. We just kind of ran out of time, and she was kind of busy towards the end of the year. But yeah, we definitely, she really loved the two strategies. She's been very happy about she got her tax return back. She's like, oh, I don't have that big tax bill at the end of the year. So that's something else too, that if you're going to be going on extension, especially whether you're a high wage earner and or a business owner, and you might be, owing six figures in taxes, we can still look at that solar strategy to carry it back to last year. Or if you're a business owner, like we talked about with Justin with the qualified plans, is that he can help put those in place too and help you get that deduction with one of those plans, whether it's you can't use a 401k because that had to be set up. It didn't have to be funded, but it had to be set up last year in 2023 to count for 2023. But the other ones, the cash balance, the profit sharing, the 401h, definitely talk to Justin about that. He could definitely help guide you. There's some parameters in terms of like the means testing and making sure it kind of checks all the boxes and everything, but definitely great ways to have some high impact strategies to bring to the table and everything. So I don't know if I'll let Justin.
Awesome.
Yep.
Yeah. So thanks so much, Ryan.
Absolutely.
The tax code is 6,800 pages long, approximately, the core tax code. To put that into perspective, that's more than 2 Bibles long. So if you have to read the Bible twice, and you still wouldn't have gotten through the full tax code. But if you add all of the different regulations and guidelines, it balloons to over to almost 75,000 pages, which would be over 23 Bibles long. And so to think that any one person actually knows the entirety of the tax code would be absurd. And so to work with various professionals like Ryan, like your current accountant, like us, to be able to try to cover as much opportunity as possible, I believe would be very, very wise. So drop your questions into the chat or the Q&A box if you have them. I think the chat might be disabled. I don't know if I did that. But first, we do want to leave you with a gift, because Ryan definitely had a lot of value. Could potentially be overwhelming, just kind of flowing all of these potential strategies on you, not knowing exactly how to discern how to implement them into your life. So next slide, Ryan. This is not going to be for everybody. It's only for the action takers, and you can probably assess based on some of the minimums and things whether or not you can actually utilize these things. Because if you go to the next one, we only have 10 available to them. And so through all of these different things, we're going to be giving away hours and hours of our time, both here at Personal Wealth Strategies and also Ryan at his time, to make sure that you're fully served. And when I say give, we're meaning give, no sales pitches, just really serving to try to get the best outcome for you. And so that's why we need to limit this, so that we have enough capacity to be able to take on and really truly serve with that value. So to break down the next slide, part one is going to be with Ryan, a 2024 proactive tax strategy session, absolutely free, no cost. And so you'll be able to meet with Ryan. You'll be able to go through some of your current tax situation, and then he can help to discern for you, with you, which of these strategies may or may not be an appropriate strategy that you could take to help you in your taxes this year, 2024. The next part of the tax planning bundle is going to be a 2023 tax report analysis. So that is the top of my parents' tax report that I just generated for them after they gave me their return. And we would do the same thing for you. The only thing we would need for this is a 2023 or prior year return, which may or may not be filed yet. So if it's not filed and you potentially want to pursue some other strategies, we can definitely still talk about that. But once it is filed, what this planning session will give to you is a full tax report looking at prior year, being able to translate the tax, the 1040 and all these different numbers that Ryan has been throwing out into English, and to kind of show you visually what your tax return looks like, so you can more better and fully understand it. Because most of the time what happens is, you compile all of your stuff, you give it to your accountant, they go and file it, they say, all right, you owe $1,000, oh, you get a refund, but you don't know how they got to that number. This report really helps to justify that and help explain it. And we give observations, not in depth as Ryan will go in the tax strategy session, but of some observations that we could utilize to help improve your tax situation for 2024. We'll look at things like, should you be doing traditional versus Roth? We have a great webinar to Roth or not to Roth that we can definitely reference as well, and get you a video of that. That would be fun to view. And we can look at other things like timing of charitable gifts, donor advised funds, qualified charitable distributions, and some of those more what I'll call basic, again, you might call intermediate tax planning strategies, and that would be covered in this session. So that's number 2. And then the third part of the planning acceleration bundle is a subscription to Money Guide Pro. Now, this is our planning software that we use for our financial planning clients. Our minimum fee for a financial plan is $3,500, goes all the way up to $10,000, but we're giving the software away completely for free. Plus, we're not just giving you the software, throwing you out into the wild. It also includes a 30-minute session with a skilled associate. It's going to be Ian Mindis that can walk you through from our office. He is very, very proficient in Money Guide Pro. Actually just passed his certified financial planner exam a couple weeks ago. And so he is a full-fledged planner for sure, very, very knowledgeable, and he will help guide you through the Money Guide Pro, being able to make sure that you're able to link the accounts, utilize it to its full potential, and be able to discuss that with you, getting your full financial picture in one place. So next slide, just to review, this is for the first 10 people, part 1, part 2, part 3. I'm going to drop a link into the chat, and I need to get that going. Before we do that, I feel like I'm on the infomercial though, but wait, there's more, because we wanted to actually make this the most valuable webinar that we have ever done, not just from a content perspective, but also from an actionable perspective of things that you can actually do afterwards to change your trajectory. It's great to watch a webinar and just learn a couple of things, but if you actually can act and take advantage of some of the things that we're talking about, that's how you're going to truly be better off. So Ryan, if you want to go forward to that first bonus, and I'm going to drop the link in the chat. I just found it to everyone. All right. So one of the ways that Ryan and I know each other, it's not the only way. We first met many, many years ago through a company of Elite Resource Team. But more recently, Ryan has joined Unblinded about 14 months ago, I believe. I've been a part of Unblinded for over 2 years now. And what they do at Unblinded has been one of the most eye-opening business acceleration things that I could have done. So if you own a business and you have a growth mindset, looking to grow and expand, I talked with Unblinded, and as an additional bonus, again, just for the first 10 people, they are offering an hour of their time for a business acceleration session. This is not a sales call. There's nothing to be bought on this call. They go through your business. They look at what you're currently doing, both from a sales meetings perspective, from a speaking engagement perspective, and give you, true advice on how you can increase those and get to the outcome that you desire in your business. So that is very, very valuable there. Bonus number 2, but wait, there's more. Callaghy Law, who is actually Sean Callaghy, he's one of the co-founders of Unblinded, also is a lawyer with a 100+ person law firm. And a lot of businesses have contracts. Well, hopefully all businesses have contracts. Though seemingly mundane, contracts and agreements are, in fact, the bedrock of security and growth for a company or an individual if you're looking at getting employment. So they've got nearly 3 decades of expertise, and they can help you, navigate through complex business agreements and for your life as well. Now, the normal cost of this is $2,997. That's a real cost for the contract review and the one-on-one session that follows it. And they're giving that away to complimentary for the first 10 people that fill out the link that's in the chat and sign up. And then bonus number 3, and I promise this is the last bonus. We just love to give value. Dr. Rhoda has been an amazing. I just met her. I believe it was earlier this year. I don't even know her for maybe 4 months, but getting to know her in what she does and her journey that she's taken from being a board certified internal medicine physician to now being a champion of wellness and driver for success. I'm really knowing that the physician, which is a large part of our client base, is increasingly dealing with burnout, stress. Reimbursements are going down, work is going up, and it's being very, very challenging to be a physician. And so to have a physician to be there to coach, to consult, to help you achieve your peak performance and really be there as a guide, like what she did, being able to grow and scale 6 urgent care practices, eventually selling them, various other healthcare ventures. So she's has critical knowledge in both being a physician and a business owner. And so that physician vitality session, again, completely free, also available to 10. So if you add all up the hours, the time that we're committing here, this is over $8,000 worth of value conservatively, and probably much, much more. And so that is what we wanted to give on this webinar. So if you're live here, that gives you a head start to get to the 10. We will have a recording, and if any of the 10 spots don't fill up, we will be able to honor that for those watching the recording. If you do click the link, it'll be there somewhere below. Ryan, anything else before we
yeah, just looking forward. Yeah, if anybody has any questions or any clarifications or anything like that, I'd be happy to answer anything. And yeah, sorry, there's not a free set of knives here as bonus number 4, but
incredible. Yes, no free set of knives yet. So keep an eye out for the next webinar to talk about that. David, we've got 1 minute left to the top of the hour. What's your final?
Well, I'm going to give you bonus number 4, and that is this whole webinar was held at, you said, basic, intermediate, advanced. We use the word, we used every different level. But one of the things that you get by going through these meetings and having these different bonuses that are being offered here is we make sure the fundamentals are covered as well. So it wouldn't make sense to do one of Ryan's advanced strategies and not be making use of a Roth IRA. okay, or not be using a health savings account or whatever it might be. So one of the things that we're going to do is we're going to go back to the fundamentals, make sure all those fundamentals are in place before moving on as well. So one of the biggest benefits we find that our clients get sometimes is just getting their own house in order. Sometimes we ask a client for a copy of their will and they can't even find it. Well, what good is it if you can't find it? Imagine someone in your family trying to find it after you've died. So getting those fundamentals in order. All right, I don't know how much of my minute I used up, but I am going to remind everybody that we do these webinars. Justin said this is our 26th consecutive month. Keep coming. They're the first Wednesday of the month. We record them. There's a huge inventory now that is in our YouTube channel. Please go there because a lot of the questions you have already been covered. And if we haven't covered it, let us know because that will give us an opportunity to pick it up in a future meeting. We have a lot of good programming coming to you for later this year. Watch your emails for the scheduling, and we look forward to seeing you then.